Hello, Rick, and thank you very much for joining us today.
Hi.
In your panel at TradeTech, you're going to be discussing the role and impact of capital markets on society and whether it's actually possible to create truly fair and transparent markets. A huge topic, and I'm sure one that's going to bring up a lot of debate, possibly as much from the audience as much as the panel. Realistically, are there ever going to be truly fair markets?
I think it's an aspiration we should certainly hold dear. I mean, we have a reputational issue to recover from in the financial services industry. And I think aspiring to fair markets and transparency is one way in which we can restore that reputation, even though a gold standard of a kind of theoretically pure market is always somewhat unattainable.
Absolutely. It's definitely one of those things it's very much we should keep striving for, but I doubt there'll ever be a point where people aren't still complaining that it's not fair enough.
Quite possibly.
So how desirable then is it to have both massively increased and utterly mandatory transparency across all trading venues and asset classes?
Well, I think there may always be a place for private markets, or at least limited private markets, to provide access to those who want to trade perhaps in a different size or a different way. So I think universal transparency that's mandatory, to the extent it limits the possibility of any other venue, could be limiting, and that could be bad for end users, end clients.
And I know that certainly when people have been looking at, say, the MiFID regulations coming in, that one of the big concerns is that it takes away the very principle of a dark pool, that actually it makes it too transparent and ends up defeating the whole purpose of it in the first place.
I think the industry needs to take a balanced approach, though. It needs to understand the concerns that people have about dark pools, some of which may be legitimate concerns and some not. And I think in engaging with regulators and policymakers, help to educate them about the benefits of private markets or dark pools, and how the industry, either on a self-regulating basis or by advocating for sensible regulation, can ameliorate some of the concerns that people have got about dark pools.
And in general then, what are the concerns that you've found coming out of the proposals, particularly with MiFID II in mind?
I wouldn't like to be specific of things we would advocate for within the MiFID II proposals, although we have been pretty actively engaged with policymakers in the process of arriving at these rules. I think what we always want to see is a balance. As I said right at the beginning, we need to restore the reputation of the financial services industry. We need to recognise what was wrong. We need to have a constructive approach to regulation. But we need to educate those policymakers in understanding some of the benefits of the old system or systems that have given rise to concerns, including dark pools. So we need to find a way of permitting them within a regulated environment that will benefit the end users.
Do you think we're going to get there then?
I remain concerned that there's a dialogue that's not successful because to some extent the dialogue can become partisan. So those who look like they're benefiting from a lack of transparency have sometimes been very strong advocates. And I think their credibility level has been very low. I think the buy side in particular needs to step up its efforts to help educate policymakers about the end user benefits. And by that I mean people who are pensioners or people with pension funds who want to maximize the value of their savings, and what the link is between that and low transaction costs.
I know that from some of the commentary that I've read, a lot of people are saying that these regulations are taking a very broad brush approach, that they feel that they're taking everything that was learnt in the equities market in MiFID I, just saying, well, we're going to take that and apply it across every asset class and essentially see how it goes. Do you think, as someone who's worked with the policymakers, that that's actually the case?
I think it's an interesting pendulum swing, and it's not a policy issue, but if you jog back 5-6 years ago, there were those who believed that equity markets would begin to look more like fixed income markets. There'd be net markets, there'd be a system which would be very much more capital intensive for trading equities. The pendulum has swung way too far, in a sense, to the other end of the spectrum, saying that everything should look like an equity in terms of how it's traded. I don't think that's realistic in some corners of the fixed income market which require capital commitment, and I don't think that's going to be realistic as an end point. But like I say, we have to have a balanced dialogue and not simply oppose every change.
Of course. And I think to some degree, a lot of those commentaries are these knee-jerk reactions that people immediately read them and go, well, this is everything that's wrong, perhaps forgetting that they are proposals and that they're still, the whole point is that they open the dialogue, they open the table and get people around it to talk. Are they, though, the regulators, the policymakers, going about it the right way, speaking to the right people and actually listening to their voices?
Well, I can't comment on who they speak to other than us. I mean, it's hard to gauge how they take their policy input. I think the industry itself needs to be moderate in the way that it expresses its views. I think painting an extreme picture of a scenario under regulation is unhelpful. I think parts of the industry can exaggerate the negative impact of some of the regulations. And I think that has the effect of reducing the credibility of some parts of the market in the eyes of policymakers.
There's obviously, it's not just MiFID, there's loads of other different, I mean, it's been referred to as alphabet soup on more than a number of occasions, but with all these directives being brought into play, is there a real danger of over-regulation and possibly even contradictory regulations coming into play, which are going to be very difficult for people to fulfill on both sides?
What would over-regulation look like? I guess it would be regulation which drove up costs in an unexpected way. So we need to be honest and open about what the likely costs are of regulation per regulation. There's no doubt that regulations have a purpose of reinsuring the system in some cases, ensuring fairness or access to markets, but mostly controlling systematic risks. Each of those regulations has some sort of cost, and we need to be honest and evaluate what they are. I do think that some of the regulations may have unexpected impacts in terms of costs, and that will potentially change the sell side, and it could change the buy side in terms of what sort of products we might be able to deliver to our clients and the way in which we might manage money.
And obviously another thing that is a key, well, is it driver, I suppose, of the regulations is MTFs and the idea of just huge numbers of additional trading venues. At the same time, we keep hearing about exchange mergers and the like, and it seems that there's some level of disparity between everyone trying to make a series of super or hyper exchanges, and on the other hand, we're having lots and lots of fragmentation. So is it possible to have both at the same time, or are we going to see one win out over the other?
Well, exchanges come with a lot of obligations that mean their economics are challenged unless perhaps they can bulk up the size of their businesses. That doesn't apply to people who don't have any sort of legacy business and starting up some sort of a transaction facility, as opposed to an exchange which comes with other obligations, is a very different sort of business from an economic perspective. I think there will be a consolidation in the MTF area as well. And I think particularly as regulations begin to flush out or prohibit practices which might have thrived in some of those venues, maybe some of them will become less viable because they relied on a certain sort of activity that frankly isn't going to be possible.
So I suppose this could be cyclical, that what we might now see is as we see these MTFs start to weed themselves out and the smaller ones begin to disappear or merge, and we might gradually see them become the larger companies and then another group of even smaller groups starting in. It sounds almost like we might see this again in, say, 10 years' time.
Well, I think we could do. I think what we need to understand is how complementary those different facilities are. Are they simply replicating what already exists elsewhere? Unless you have some sort of heterogeneity in the range of services that are available to clients, then there will be overlap, there'll be overcapacity, and the economics won't work out, and there'll have to be mergers or shutdown.
And another piece of potential regulation of a sort that people have been talking about is the Tobin tax, the financial transaction tax. Is it as bad an idea as so many people in this sector have claimed?
I don't like the idea. It's a question of degree. I live in a country where we've got a 0.5% tax on buying equities. Exemptions, obviously, for market makers, which permits very different sort of activity to take place behind the scenes. But in the end, we've had to manage that as buy-side managers, or our clients have paid that tax for decades or even centuries. So it's not unfamiliar to have a tax on transactions, but I think it is unwelcome. Again, it's a question of degree. We've estimated the cost to our clients of a Tobin tax in terms of the face value. And it's not necessarily significant unless we're running a very high frequency trading strategy, which we're not, or in a certain type of a certain type of asset class, where the cost might be higher than perhaps people would expect. But it's really within the market making and behind the scenes that I think the Tobin tax begins to bite quite significantly. And I think it may be the case that the tax take has been overestimated because behaviour will change potentially quite significantly. But I think also the effect on spreads may not have been estimated very well, either by the advocates of no change or in fact by the people proposing the tax.
I suppose as well one of the reasons for the negativity, not just obviously because it's a tax and nobody likes a tax, but because it seems to some degree to be a political tool that's come in a bit heavy-handed to say, look, we really are taking these bankers to task, rather than necessarily thinking it all through. It seems like, again, I know we've used the phrase before, but a very broad brush of a piece of potential regulation when it lacks the finesse that might be needed to do what it claims to do, which is to try and curtail fake and cancelled orders that were just intended to try and push high-frequency trading and make people's algorithms work the way they want them to.
Well, let's face it, there is a strong belief that it will raise a substantial amount of money, and Europe has a fiscal challenge. So we can't ignore that side of the motivation either. But I think you're right that there is a world view or a view of the world which inspires the tax that may advocate for a more slow-moving capital market, and also a sense that a lot of the capital market activity is not beneficial. I think the industry, both the buy side and the sell side, needs to clarify a little bit more successfully what high frequency trading really is, which is basically it's a tool for market making. Some investment strategies are high frequency, but I think an extremely small number. And I think there's a great deal of confusion about high frequency trading and the fact that companies might be owned by their shareholders for a very short time period and then sold. I think the vast majority of the industry is a buy and hold industry. They have long-term relationships with their investee companies. And I don't think the banning of high frequency trading will change that at all.
Absolutely. And will it lead, though, to necessarily a shift in power amongst Europe's financial centres, particularly London? Obviously, the biggest fear that's come out of the UK is that everyone's going to leave London and go elsewhere.
I respond to that two ways. One is that London doesn't need to be synonymous with high-frequency trading, or at least London's presence in Europe has nothing to do with high-frequency trading. I've been an asset manager for over 20 years in London, and it has been a substantial financial centre throughout that time period, which started a period where high-frequency trading frankly didn't exist. Trading was undertaken by securities houses rather than banks predominantly. So there have been a lot of changes during which London has continued to be a substantial financial centre. But there's another part of the question, another part of the answer as well, which is that London is not really anything to do with the UK in the financial market sense. If you look at the composition of people who work in London, very many of them are not British. They would have the same viewpoint when it comes to transparency, high-frequency trading, if they happen to sit in another part of Europe. I really don't think the geography of London is affecting attitudes that market practitioners have that may be things that some people in Europe wish to change. Those attitudes, those points of view about short selling, about high-frequency trading would exist wherever the practitioners happen to be.
And talking of the view of high-frequency trading, it's often cited as one of the reasons behind the financial crisis. Do you actually feel that that's the case, or is it just scapegoatism on something that people don't necessarily understand?
I haven't seen the evidence. I mean, there may be other challenges that high-frequency trading bring, but I think the lending of money to people in the US who in the end weren't easily able to pay it back, which is at the heart of a lot of the financial crisis, I don't think had anything to do with high-frequency trading whatsoever. There are challenges that high-frequency trading bring, And there are venues that obviously need to be looked at in terms of whether they can be improved in terms of the behaviour of the participants. And you talked about these orders that never exist, the fake orders, and so on and so forth. I mean, that's definitely worthy of examination. But did that cause a financial crisis? No. I can't see any connection or any evidence that leads to that conclusion.
Well, thank you very much for taking the time to speak with us. I know time is very short, so I look forward to seeing more from you at TradeTech itself in April. And if you'd like to find out more, see more interviews like this from various white papers and reports, you can visit www.tradetecheurope.com.